All right, welcome to this explainer. Think of today's session as a terminal diagnostic scan for your portfolio. We are diving straight into the current market landscape, taking it all the way from top-level macro indicators right down to the micro contrarian plays happening right now. So let's just get right to it.
Here's our agenda for today's sweep. We've got 6 modules. 1. The current market pulse. 2. The AI infrastructure engine. 3. Structural distortions and squeezes. 4. Systemic foundations and bottlenecks. 5. The contrarian rotation playbook. And finally 6. Upcoming horizon catalysts. Let's move on.
Kicking things off with Section 1, the current market pulse.
Okay, let's initialize the system here. To figure out where this market is actually heading, we've got to look at the broadest economic indicators driving behavior right now. And honestly, it all starts with one absolutely crucial number, 4.40%. The U.S. 10-year Treasury yield is finally cooling down, dropping 2.22 basis points. Now, you might be wondering, why does that actually matter? Well, when yields pull back like this, it gives the broader equity markets some real breathing room. It just lets the whole system maneuver a bit more freely.
And check this out, at the exact same time we're seeing this fascinating normalization across commodities. Crude oil has dropped about 4.6%, down to $69.85, and gold just dipped under $4,013. What we're really looking at here is the war premium deflating. With tanker traffic picking back up and improving in the Strait of Hormuz, that geopolitical fear factor, it's just rotating right out of commodity prices, letting the system cool off.
Moving right into Section 2, the AI infrastructure engine.
Now that we've checked the macro polls, we need to look at the sheer undeniable engine powering this market right now. Guys, we are talking about an absolute monster of a breakout quarter for Micron. They completely smashed earnings. We're looking at a 346% revenue jump to $41.5 billion, plus a staggering 415% year-over-year growth, specifically in their data center sector. But here's the real kicker. They went ahead and secured 16 long-term supply deals that literally locks in $18 billion in free cash flow to hedge against any future downturns. That is massive.
And this perfectly illustrates a huge paradigm shift in the AI ecosystem. For the longest time, everybody kept talking about the NVIDIA tax, that hefty premium you just had to pay for GPU processing power. But that paradigm, it's shifting. We're moving away from a tax on processing and straight into a mandatory memory toll. You simply cannot run these massive AI models without the specialized memory backbone to support them.
If we map out the current ecosystem, a really fascinating picture emerges. Look at NVIDIA here. It's now categorized as a disrupted monopoly. They're facing some intense custom chip competition from giants like OpenAI and Broadcom. Meanwhile, the memory infrastructure players are just killing it. Micron is in a full-blown hypergrowth phase, and SK Hynix is in this massive capital formation stage, raising $29 billion. On the flip side, custom chip maker Cerebras is actually in contraction, with shares plunging below their IPO price over margin fears. So the takeaway? Capital is aggressively flowing straight toward the memory backbone.
Now, what's really interesting is how massive capital allocators like SoftBank are playing this boom. They've essentially structured themselves as a pure value creation engine. Think of SoftBank and ARM as the goose in this scenario. This goose just continuously pumps out these massive infrastructure eggs, and each of those is valued at roughly 1 trillion Japanese yen. SoftBank's Masayoshi Son actually argues that the market is severely undervaluing this exact mechanism. His thesis is basically this: you can't just look at their present assets. You have to account for their capacity to continuously generate this AI infrastructure over the next 40 years. And guess what? The market is definitely starting to believe him. It completely explains why SoftBank shares have shot up 189% over the past year alone.
All right, Section 3, structural distortions and squeezes.
So what actually happens under the hood when all this capital crowds into one specific tech sector? Well, we start seeing these major stress fractures and fundamental flaws in the very benchmarks we look at every single day. Take a look at this comparison. On the left, you've got the Dow. It's price-weighted. That means it's swayed by completely arbitrary share prices, which, let's be honest, is a pretty meaningless metric for actual company value. It heavily balances giants like Caterpillar and Goldman Sachs, but largely filters out big tech. Then on the right, you have the S&P 500. It's cap-weighted, so it reflects true corporate scale. But because of this insane AI boom, it's become dangerously top-heavy. It's highly susceptible to concentration risk from just a tiny handful of mega-cap tech winners like Apple and NVIDIA.
The absolutely crucial point here is that these distortions aren't just messing with the major indices, they're creating these wild, volatile microenvironments. Take Wendy's, for example. The stock just randomly surged 42%, even though it's been trailing the broader market for years. Why? It was a perfect storm. It started with a vulnerable, relatively low market cap of $1.2 billion. Wall Street got skeptical, which led to excessive short interest. About 30% of the float was shorted. That essentially created a trap. Throw in a viral retail narrative, the whole Save Wendy's thing, and then, boom, a billionaire catalyst. Nelson Peltz and Trian backed it with a $93 million stake. That added instant perceived legitimacy, forced the short sellers to cover, and ignited this massive feedback loop.
Moving to Section 4, Systemic Foundations and Bottlenecks.
So with all these wild swings, crowded tech trades, and volatile retail squeezes happening left and right, we really need to take a step back and ask, just how resilient is the actual foundation of our financial system? Well, the good news is, according to the 2026 bank stress test results, it's incredibly robust. They tested 32 major U.S. banks against extreme economic shocks. We're talking a simulated 10% unemployment rate and a massive double-digit collapse in real estate. The result? These banks hold a proven $708 billion buffer. They can absorb massive loan losses, keep functioning as lenders, and somehow still return capital to shareholders through dividends and buybacks. Pretty impressive.
But while the banking system looks totally secure, we've still got these massive systemic bottlenecks in the physical economy, specifically when it comes to housing. Have you been following the bipartisan 21st Century Road to Housing Act? It's designed to ease zoning rules and ban institutional investors from just buying up existing family homes. Great idea, right? But its path is completely gridlocked by political friction. President Trump actually vetoed it, demanding the attachment of strict voter eligibility limits. So now, it's just a pure legislative math problem. The Senate needs 60 votes to override that veto. The GOP holds a 53-47 majority, but there is zero Democrat support for those voter limits. That said, analysts over at Evercore believe Congress does ultimately have the 60 votes needed to override the veto, which would keep this structural housing reform viable in the long run.
Next up, Section 5, the Contrarian Rotation Playbook.
Okay, so we've seen where the capital is super crowded, and we know where the systemic bottlenecks are. If you're feeling a little AI exhaustion from all those concentrated tech trades, where's the smart money actually looking to rotate next? Our radar is pointing straight at 5 really fascinating contrarian themes, all grounded in under-the-radar, physical world fundamentals. First up, airlines. They're facing a capacity squeeze right now, sure, but they are going to see a massive tourism uplift from the U.S. World Cup. Second, senior living. We're hitting a crazy demographic cliff. As the oldest boomers hit 80 and supply remains tight, these facilities are starting to yield incredibly high margins. Third, live events. They're riding this wave of physical premiumization, where just being physically present at an event has literally become a post-pandemic luxury good. Then, let's look at structural shifts in finance. The playbook right now suggests shorting incumbent exchange monopolies, like CME and SIBO, as new 24/7 equity index perpetuals break their grip. Instead, the move is to buy early adopters, like Robinhood and Coinbase. And finally, buy now, pay later lenders. There's this persistent myth out there that they're the next domino to fall, but the reality is just a weird accounting disconnect. GAAP rules force them to take upfront provisions for credit losses, but their revenue gets recognized over the life of the loan. So these fundamentally strong companies just look artificially weak in the short term. It's a classic misdirection.
And finally, Section 6, Upcoming Horizon Catalysts.
Now, if you want to execute any of these rotations effectively, we've got to map out the upcoming data injections. What are the actual milestones that will move these markets next? Keep your eyes on this horizon timeline. It kicks off with the May PCE data, which is the absolutely critical indicator for the Fed's rate path, currently expected at plus 0.4% month over month. That flows right into durable goods orders, where consensus is looking for a 0.8% rise. And we'll get corporate earnings from transport and consumer companies to give us some real ground truth data. After that, we hit the big macro releases, revised Q1 GDP and initial jobless claims. And wrapping it all up, we'll get direct Fed speak from the NY Fed's Williams and Chicago Fed's Goolsbee. Those remarks are going to contextualize all of this data and really signal the market's next move.
So that brings us to the ultimate question you really have to ask yourself as we wrap up this explainer. With the memory toll completely locked in, major indices looking dangerously top-heavy, and all these systemic bottlenecks creating totally unique value traps, what's your play? Are you going to keep chasing that crowded, exhausted AI momentum trade, or is it finally time to rotate your attention into those under-the-radar physical world fundamentals? The data's right there on the terminal, guys. The next move is completely up to you. Thanks so much for joining me on this scan, and keep learning.